Okay, good afternoon or early evening, and we're going to get started on the second edition of Hardball with Hitchner. Obviously, I'm Jim Hitchner, and I'd like to briefly introduce the panel. I think almost everyone knows Lari and Marc, but I'll give a brief introduction. Lari's a CPA, ABV, CFF, CVA, A-Bar, and MAFF. Owner of Masten Valuation, adjunct professor at University of Denver, NACVA instructor of exceptional distinction, co-chair of this conference. Good job, by the way.
Thank you.
And has been and participated in various NACVA boards. Marc Bello's a CPA, ABV, CVA, MAFF, CFF, MST. Partner at Edelson & Company and head of their BV and forensic group, frequent lecturer, excuse me, past lead instructor for current update and valuation, and he's also been on many NACVA boards. And for those of you that weren't here yesterday, how many people here were here yesterday? Okay, good. As you know, we have one rule. No one's allowed to say it depends, and if they do say it depends, you'll get to boo them. So, and boo them loudly. We only had one boo yesterday, one boo. So now, obviously you've got the two microphones here. We're here to answer your questions. So I have planned questions here just to get things going, but we really want to hear from you, what questions you have. Don't be intimidated. No one will jump down your throat. No one's going to argue with you. So please ask any questions that you have. All right, to lead off, we're going to do a little soft topic here, but an important one, and it could be an interesting one. Lari, I'll start with you. What's the most unusual thing you have seen happen at a trial that you participated in?
That's an interesting question. I guess this is probably not going to be the response you expect, but it's a good one. I think the most interesting thing that happened at a trial that I was participating in is I was engaged in a trial that was out. It was out of town, out of state. I had to fly out there to get there. It was kind of in a more rural setting and location. And I arrived early, and it was, maybe 20 minutes early before we're supposed to be there. Retaining counsel wasn't there. Opposing counsel was kind of out in the hallway. I chit-chatted with them a little bit, but they usually don't like to talk too much to you at that point. And so I decided, well, I'll just go on and go into the courtroom and sit down. And so I opened the doors, and it's almost like I felt this heat wave of humanity because it was just completely full. And it was, we're supposed to be there. It was a 9 o'clock trial. I didn't expect anybody to already be in there. There's a judge there, and there's all these people in orange jumpsuits and shackles. And the judge is handing out sentences, and you hear wailing in the audience and everything. And I'm just like, what is going on here? And it was pretty quickly over, and the judge left, and the mass exodus of the humanity. Retaining counsel gets their chit chat, whatever. And then you hear the all rise. And so we all rise, and in comes through the curtain the same judge that had just been doing all the criminal sentencing. And I had teed up this perfect technical argument on this one issue that I thought I'm going to really get my point across on this. As soon as I saw that it was the same judge doing all the criminal sentencing who's going to be listening to our technical issue, I was like scratching everything out, telling the retaining counsel, we've got to change the whole thing. So I think for me, walking in and being shocked with all of those criminals, and then seeing that judge was going to be making a decision in my case, that was pretty shocking.
Imagine. Marc, how about yourself?
Not quite the same experience, but in a similar line where I was in court getting ready to testify for a case. And next thing I knew, one of the litigants strolls into the courtroom, is about to be sworn in when the state police come in and arrest him. There'd been a warrant for his arrest. And for whatever reason, as just being the valuation person, you don't know everything that goes on in the case, but to see one of the litigants who's involved in your case being cuffed, taken out by the police, and then having the trial to have to continue after that was quite a shocking event to me.
Imagine. I'll give you a story. The first time I ever testified in a courtroom was in Trenton, New Jersey, and it's a multi-story building that has a square atrium. Each floor has, you know, the atrium there in an open space. And I had never testified before. And so I go with listen to this. We're valuing a company owned by, we're valuing a concrete company in North New Jersey, owned by 4 brothers. And I was working for the one brother that the other 3 brothers were throwing out. And so before I got to testify, first time, a fist fight broke out between the brothers outside the courtroom, and one brother tried to throw the other one off the 4th floor atrium. All right. And then I walked down the courtroom, into the courtroom. One of the brothers comes up to me and threatened me. And then the lawyer comes up to me that I'm working with and said, Jim, not all my cases are like this. All right. And that was my first case I ever testified in. So, and there's some other funny stories that we've all had. Let's get into a little bit on another question on litigation. How do you make comparisons with an opposing expert's valuation rationale and conclusion and prove your results are more credible? Because one of the things that I see happening is that I'll do an unbiased down the middle valuation. The other side rigs their valuation and is either higher or lower than mine. What does the trier of fact think?
Split the middle.
Both of us are unethical, okay? And that both of us are gone to the extreme, even though that's not true. So often we have to overcome that. Real short story, and then we'll go here. I used to teach judges at the National Judicial College. And the first time I went out to dinner, I asked them what they look for in an expert. And they said that one of the judges said, well, let me tell you this. When you walk into the courtroom and the other expert walks into the courtroom, I assume you're both biased because your number favors your client and his or her number favors their client. Otherwise, we wouldn't be here. And then I said, oh my gosh, and all the other judges nodded in affirmative. And I was like dejected. And then the judge, I was younger then, the judge looks at me and goes, however, if you prove to me that you're not biased, I will go with you. So, and I've never forgotten that. But Marc, I'll let you take this one off, kick this one off.
So this is one of my favorite topics because I think it's really important when you try and do, and you have the credible valuation and there's an expert report on the other side that has biases built into it. And as Jim said, the judge thinks you're both lying. The way that I like to approach it is I basically will start from all the way from the beginning of analyzing the financials to normalizing adjustments and cost of capital. And I will show where each of these adjustments results in either higher, lower, or neutral impact to the valuation. So if you could show that in the valuation that I've conducted, you know, maybe I'm higher on the financial statement, but my cost of capital has more risk because my financial statement has been aggressive, they kind of weigh themselves out. Where if the other expert has a higher adjustments that relate in more profitability, the more profitability, a lower discount rate, and all the adjustments tend to skew to the valuation consistently, higher or lower, is a nice indication to be able to demonstrate that there's objectivity versus non-objectivity in the report.
Okay, Lari?
Yeah, I think I follow kind of a similar aspect. It kind of does depend on, you know, what I might determine is egregious about the other expert's opinion. I take a slightly different, you know, route though. I will start off with where we agree. We agree on these things, and this is where we disagree. And the reason why my opinion is where it is for these factors. And going back to, does this decision increase or decrease value? Does the second decision increase or decrease value just on its own? And then showing that they have a tendency to, you know, I don't have a bias towards always making decisions to have a higher or a lower value on these areas that we disagree. And maybe illustrating where the decisions that the other analyst has made or the other expert, that they do have that same tendency. I do think that that's probably the easiest way to prove my reasonableness. Credibility then comes into play when you illustrate the work that you've done. I've seen a lot of cases where you have the initial expert who's done a lot of work and another expert just comes in and says, well, I agree with this, and this, so I just adopt it. Usually it's a budget issue on their retaining counsel. And then they just, have one disagreement in one area that usually doesn't come across very credible with the judge, because they'll say, well, Ms. Masten did all this work and you're just adopting all of that. And then you just disagree with her on this one area that parenthetically, and by the way, is in your client's favor. That just doesn't look credible. So I think there's a reasonableness factor you have to set out, and then a credibility factor that you have to shore it up with.
Okay. One of the courtroom techniques I use, I don't use it in every trial, but I have used it and I like to use it because it makes the lawyers on the other side nuts. And that's a good thing to do, in my opinion. By the way, for those of you that are younger that haven't testified yet, don't do what I'm about to tell you that I do. All right. What I'll do, it depends on the complications of it. I'll do what I like to do. If you prepare an exhibit, you have to give it to the other side. Usually you end up getting theirs the night before, and usually you give theirs the night before. Sometimes the night before is 2 o'clock in the morning, particularly if you're in state court versus federal court. But what I like to do is to tell the lawyer I'm working with, I'm going to ask the judge, can I get up? When we're comparing, when we get to the point where, Mr. Hitchner, you did these things and came up with this value, the other expert did these things and came up with that value, can you explain the differences? What I'll do is I'll ask the judge, can I get up and go to the whiteboard? And I've never had that denied. And I walk up, pick up a marker, and I start writing, because how can you give that to the person to the other side? You can't. And nothing makes them, and you should see the lawyers scrambling, coming around, watching me write on a board, and they are not prepared for it. And it makes them nervous right away. I don't care how good they are. And they won't show that they're nervous, but I know. And so I'll go say, Hitchner, other person, and I don't memorize this. So, and usually there's what? Maybe no more than 5 major items that you disagree with. So I stay away from the small stuff, concentrate on those 5, 4, whatever it is, and then I'll write, and then I'll explain it to the judge. And now the other side is going to want to cross me on that, and they're not prepared. And so lawyers use a lot of tactics to try to throw you off base, all right? But no one says that you can't use tactics to try to throw them off base. And the other thing is, I'm not doing anything wrong, because I am indeed explaining the differences between the two. But but when I have extremely complex cases, obviously I can't do that. But when it's, not that complex, and there's 5, and it's just a straight up BV, and there's only 5 or so items, it works very, very well. And so that's one of the ways that and then, we point out the differences, and then I'll explain why I think what I did is a better way of doing it than the other side. And so that's how I'll go about doing that. All right, Marc and Lari, you guys, and I sat in on most of it, you're DLOL, DLON, okay? Mm-hmm. And, but let's talk about, you didn't talk about the databases or the models that we use in these types of databases. By the way, I apologize for how nasal I am. I'm getting killed with allergies here. As soon as I landed and got to here, I think, Lari, you said you're getting some as well. But let's talk about some of the methodologies, databases, studies, and so on. And Lari, I ask you first, what do you use to determine the discount for lack of marketability? Let's stay away from discounts for lack of liquidity for control. Your value in a minority interest. What methodologies, databases, and such do you use, and why?
Okay, that's a fair question. So I would only be using this on a non-controlling interest, and I will, depending on the purpose, who the audience is. Let's just assume it's like for the IRS. I will definitely first default to the restricted stock studies. but I won't use like all of them in general. I'll try to pick, you know, a couple of the benchmark studies that match with the type of business that I'm valuing. So, you know, and then apply a Mandelbaum, you know, analysis to that. And I may, you know, one of the things that we were discussing earlier is how do you bridge the gap between, let's say I have a 35% discount from my restricted stock studies, or 32 or 31, 29. And, you know, if I'm, how do I bridge, you know, the discussion and support for that adjustment to where I actually land? What I will identify why my interest is less marketable than those securities that were included in the study. And I will back that up with using some of the other resources that we have. So, you know, I might run a QMDM and just verify, you know, where that falls out is close to, you know, that makes my adjustment to landing at, you know, 34% reasonable if I start at 29%, because that would prove out, you know, where that percentage might stay. I'm not one of those analysts that will do 12 different models, average them all together, try to explain them all using an option pricing model, and, you know, leaves, you know, I try to stay away from the complexity of the criticism that, well, you just don't even know what to rely on, so you're just relying on all of them, aren't you? So that's my kind of motto is, you know, keep it simple and try to use one really good one and that fits in the scenario, and then shore it up.
So are you using what I call legacy benchmark restricted stock studies? You know, all the people that have books have that chart, and it keeps getting bigger and bigger.
It does. Well, I do, and my rationale is usually based on how long the company's been around and what's the long-term holding period of what the interest is. And, you know, the different studies, newer studies, FMV studies, looking at, you know, shorter time horizons. Well, that's not reasonable. That doesn't exist for my company. You know, that's not reasonable unless there really is a liquidity event that might occur within my subject interest. So I will back up and say, you know, these longer term hold periods make much more sense in the application for my company or my subject interest, because it's not likely they're going to sell within 2 or 5 years even.
Mark?
In the work I do in the litigation area a lot, we don't come into doing a lot of discounts all the time. And what we find is that we are going to go in, and we've jumped around a lot, and we try and find either a restricted stock study or pre-IPO study that might be specific to what we need to incorporate into our engagement. And then we use the Plurus database to try and find comparability. And then the last step we took is we have actually gotten the VPS DLOM toolkit, which, because
Thank you.
it's not, and by no means is it a plug.
VPS is my company, but thank you.
But what it did for us is, where we're not in the weeds all the time, is it was a way for us to be able to identify to our subject company and pick what we thought was the most applicable way to do it. So we're always looking for the tools and keep up with ways to apply versus, we don't use a chart that just says 30, 35%. We try and look at the company we're valuing, how can we get it to be attributed to our subject company.
Okay. I mean, obviously we use the VPS DLOM guide and toolkit to do a lot of our work. But in putting that guide together, and you mentioned pre-IPO studies, we did all kinds of research on this. I mean, it took us 3 years to do that book. And one of the things we found out is the problems with the pre-IPO study. We didn't know how bad they are. And we didn't know, because basically, if you know the pre-IPO studies, it's transactions prior to the IPO and whatever that price was. And the SEC reviews those, the auditors review those, and then they compare it to the IPO price. Well, and that's supposed to be the discount for lack of marketability. That's nonsense. It's not. Is lack of marketability a component? Of course it is. But it's often not that big a component. We investigated, I don't know how many transactions in the pre-IPO studies, and then we just stopped, because most of the time, the difference in the price prior to the IPO and the actual IPO price had to be due to changes in the marketplace, the economy, the company's earnings margins, the company's growth rates, There were so many company-specific and macroeconomic type things affecting it. And you got the MDAs and the disclosures. And the MDAs are incredibly, in the last 10 years, incredibly detailed on why there's differences between the price paid prior to the IPO and the IPO price. And very little of it is the discount for lack of marketability. The other funny thing is when you read the MDAs, they'll say what they did. They did discounted cash flow. They did market approach public. And then they'll say, and we threw in a discount for lack of marketability because it's not public yet. And almost always it's small. The actual, because usually they'll go outside, find someone to value it, reviewed by the auditors, reviewed by the SEC, and it's small. So those pre-IPO studies, you know, what are they usually 40, 45%, something like that. Most of the difference between the transaction prices before the IPO and then and compared to the IPO are only a little bit is in general is a little bit. But we found this day in and day out when we were going through all that information. So I would give, whatever you do, if you're going to use pre-IPO studies, do not use them by themselves. So I'm glad to hear, Mark, that you're saying you look at those, but we've actually taken them out of our report. We don't rely on them anymore. So, and I still think the benchmark restricted stock studies have their place. We have our own way of using the stout restricted stock data and the plurist data. And if you talk to Mike Gregory, formerly with the IRS, I mean, he'll tell you they don't like, when he was there, they didn't like this. There's 3 steps in the stout analysis. They only like step 1. They don't like step 2 and step 3. One of them is the VIX and some other things. But we've always only done step 1. And then the database that we have now and the model that we have, it incorporates changes in risk and changes in a whole variety of things to get down the subjectivity that's involved in doing a discount for lack of marketability. So anybody using options? Either one of you using options? One of the problems with options is they were built for short periods of time. So one of the ways to do it is to actually use the option models and do it for a short period of time, and you may get 20% or something like that. And then you can add on to that. Because if you use these options, you put 5 years in, 6 years in, they go bananas. They break down. So, and options are used, so option analyses are used a lot in the fair value, and some of that is indeed trickling down. All right, one of my favorite topics is transaction databases. And I've spoken on it quite a bit, but let's get some input from our panel here. When you have transactions where both the buyer and seller are private companies, what level of reliability do you apply? And by the way, for example, deal stats now, the large majority of the transactions are private company buying private buyer. And I think BV Resources does a wonderful job putting that information together. We've been, subscribed to deal stats for a very long time. I'm not being critical about any of the vendors, in that regard. But when you have a private company buying a private company, how much information do you have? By the way, if you haven't been to our booth, I'm not trying to push products, this is free. We have a checklist for using the transaction method when it's a private buyer and a private seller, which is most of the time when you're valuing small to medium-sized businesses. So, Lari, I'll ask you first. Use it as by the way, if you one of either the buyer, the seller, or both are public companies, that's a whole different ball game. And deal stats, it used to be public stats part. Deal stats has those type of transactions, as does done deals. Done deals requires the transaction to have at least one public company in it, because then you're going to get public company disclosures and you can do other things. But let's just stay in the world that a lot of us live in, and private buyer, private seller. What level what level of reliability, Lari, do you use? Primary method, corroborating method, or dismiss the method?
I won't say the D word, But I do think that in some way, my decision on whether it's a primary method or a backup method or discarding it relates to how many data points I actually have. So
Okay.
DealStats has the most data points per transaction of any of the databases. So I do like and appreciate that. So of the databases combined, it's good that you're asking about that one. But within that database, once I've filtered and gotten to where I'm going to land, if I only have like 5, 7 transactions I'm relying on, disregarding the private versus private and the informational issue, I don't think that that's as strong as maybe my income approach. But if I have a wealth of data points that really fit well, my thought is some of those inconsistencies that you might perceive are there when it's a private transaction with a private, another private entity. I think the statistics will normalize some of that out. And so I feel pretty confident that if I do my statistical analysis right, I do my filtering properly, I have a strong, good harmonic mean, with the multiple that I'm going to use, then I can use that as a primary method. But my decision is going to be who my audience is. If it's a litigation matter and if my audience is, going to be a judge or a jury, I would like to use the market approach because it's easier to explain.
And in my experience, even though there's a lot of troublesome aspects to private buyer, private seller, which most of the transactions are, I think judges like it.
I do.
Because you take this number, multiply it times this number, and you get this number. Mark, how about you?
And we're always considering the transaction methods. And what I like to do is almost put it back into a sensitivity at the end of the day, where if you can't use it as a primary methodology, but you can have all your statistics of where certain market multiples come up, can then you relate it to your income approach. So I think even going back to your first question in credibility, is my income approach producing a market multiple that falls somewhere in the sphere of reasonableness of that completed transaction data we have?
Okay. In our shop, we'll run the transactions, and this is interesting. If we run the transaction method and we apply it and it comes up with a value that's close to the income approach value, we put it in as a corroborating method. Now, there are times when we'll apply it and it comes up with a different value than the income approach. So what do? You have two choices. You can use it, you can dismiss the method, which a lot of people do, and I've done, or you can put it in as a non-corroborating method. How many people, show of hands in this room, have ever put the transaction method in as a non-corroborating method to the income approach? I didn't think so, okay? There could be a dilemma with that in a cross-examination. This would be could be a trial, but usually in a deposition, well, they'll ask you, so you only use it as a corroborating method when it's close to your income approach, but you don't use it and you dismiss it and you don't disclose it when it's not near your income approach. A cross-examining attorney could have some fun with that. So that's just a caution. I'm not saying, you got to put it in as a non-corroborating method. We don't do that. But we will state we attempted to use a transaction method when we dismiss it, and we'll write down why we think it should be dismissed. And a lot of the times, you got the transaction price as of the transaction day, and the financial information that the multiples are derived from can be as much as 2 years prior to the transaction. So you're applying a multiple of financial performance of the company 2 years ago. I have a rule of thumb, and again, all rules of thumb are bad, okay? But I have a rule of thumb is I don't like to go beyond 9 months. So, because now did you think that anybody bought a private company based solely on a financial statement that's 2 years old? No. The thing is, they tried to get the data, they couldn't get it. It's the best they could do. So, try to be careful with that as well. All right, next thing. What about cost of capital benchmarks? Small to me, I'm not talking about mom and pop Main Street businesses. Maybe the company is worth $5 to $10 million, maybe a little more. Just deal with cost of equity. Mark, what do you think is, in general, there are exceptions to all of this, okay? Depending on the industry, depending on the company, but in general, where you landing? By using, I'm assuming, the build-up model or the
Right.
modified CAPM.
And I
Probably the
think-
build-up model in such a small business.
Well, it's interesting because we've had this discussion before, because when we've looked at, valuing these $5-10 million companies, what I always find fascinating is when you look at the traditional historical build-up methodologies that we have, if you look at rates of return for the small companies, you should be somewhere around 18-20% on the empirical data. But if you run a build-up methodology or a CAPM, you're 15-16%. You can never get back to the true risk. And, I know, Jim, all you asked me is what general area are we getting for our discount rate for small companies? And it tends to be somewhere between 14 and 20%, depending on what we do on all the different factors that are in there.
And I would add, barring heavy reliance on a single individual, and probably barring heavy customer concentration or even supplier concentration or something like that. So what about you, Lari?
Yeah, I'm probably in the 18 to 22% range-ish. Again, barring those elements that you stated, but there could be elements of where your market is, in a rural area, you're in a high populated area that has, more need for your services or your product. But yeah, in general, probably 18 to 22%.
Okay. I often say high teens, low 20s. All right. But I will share a story. Some of you may have heard this. I'll try to be quick. For whatever reason, I was asked to run a conference at the Illinois CPA Society about 20 years ago. And a very good friend of mine, Larry Karsh, Jerry Karsh, still a friend of mine, still doing BV, and he's in his mid 80s. I did a presentation on modified CAPM and the build-up model. And he raised his hand, and I asked him to stand up, and he stood up. Yeah, I don't know, 400, 300 people there. And he goes, Jim, I understand what you're doing. I don't do any of that. And I said, well, can you explain? This is the first time I met him, and we've become friends since. And I asked him, well, what do you do? He goes, well, this is true story. I start with 20%, and if it's more risky, I add a little bit. And if it's less risky, I take off a little bit. And everybody laughed, Guess what? High teens, low 20s. You're 18 to 20, and you're what, 18 to 22 or whatever. All right. So Jerry Karsh, a very smart man 20 years ago. He's still a smart man. So, but sometimes we get too caught up in all this minutia. And most of the time, 1 or 2% is not going to have an eye. We're talking about cost of equity here, by the way, not weighted average cost of capital and not cap rates. Chris, you got a question?
Yeah, I do. Thanks again for doing this, guys. Where do you fall, all of you, on industry premium? Sometimes
What premium? I'm sorry.
Industry premium.
Okay.
I mean, sometimes there's so few companies, that are surveyed in there, or maybe the industry code's a 2-digit code. When do you use it and when do you don't? And are you concerned about defending that position? Maybe you didn't use it and someone says you should have.
Anybody want the industry risk premium?
I'll jump in on that.
Okay.
It was, I think it was 2002 or 3 when we first started having a resource that Morningstar was doing that actually, calculated the industry risk premium and published it for us. So prior to that, we always included this industry risk adjustment in the build-up method, at least in conjunction with the specific company risk. So if I have data that's, beta data, got to say that one, or industry risk premium information that I think is sketchy or limiting in some way, or not consistent with what, if McDonald's and I'm doing a small, pizza shop in industry, dispersion like that, then I'll just not include an industry risk premium specifically from that resource. And I'll embed that risk either in the benefit stream or in the specific company risk. But to be consistent, those same analyses, that same whole valuation probably will not lend itself well to the guideline public company method, because the industry risk premium data is coming from the public market. So if I'm saying that the industry risk information is bad, then I probably shouldn't be also using the guideline public company method or relying on it in some way. So I try to make sure that I'm consistent that way.
Mark?
And just the way Lari ended is where I was going to pick up. So she kind of took my answer in a way, is when you look at the industry risk premium away.
I'll ask you first next time.
Thank you.
Yeah, okay.
And I'll still answer it the same way, however she answered it.
All right.
But there is some correlation there that I think, because you're talking public markets, if you're going to throw in an industry risk premium, you really need to go to the marketplace and see what the risk is there. And if you can get comparable companies to your subject company and blend it in, that's a better way to do it.
Yeah, if I'm doing a guideline public company method, I will use the risk beta information that I get from those, companies that I'm using as the benchmark in that other method. Instead of using some published information somewhere else, I'll create that risk from the other method.
Our Excel models are set up to use both the build-up and the modified CAPM. And sometimes we'll say the modified CAPM is not too good, we'll throw it out. But often we'll do both. And we'll find some betas from some public companies. Sometimes they're good, sometimes they're just okay. And then we'll also take the industry risk premium. And the thing is, as Lari said, all the when you did your search for guideline public companies, all the companies that you rejected as not comparable are in the industry risk premium. Remember, these are all public companies, and the industry risk premium is based on beta of the public companies. Theoretically, if you used all the betas from the public companies, you should get exactly the same answer if you use a modified CAPM with a beta and you use a build-up with the industry risk premium. You should get exactly the same number. So there is a conundrum. And the only answer you have, if the industry risk premium is the only thing you're using, is you're just saying this is a broad industry risk. This company is in that industry, so I'm putting something in. But I have no problem getting rid of it. If I can't find anything that's nearby, or there's not enough, the Duff and Phelps data analogy, you need at least 10 data points. It used to be 5 when Morningstar owned it. But I don't have a problem dismissing it. So where do I make that up? In the company specific risk. So I don't like putting industry risk premiums in unless they're fairly close. All right, talking benchmarks again. And benchmarks is a fancy term for rules of thumb. Again, they're bad. All right. But everybody wants to know about them, including me. What about long-term growth rates? If you're doing a DCF and you have a 5-year model, let's say, and then you're going to come up with a long-term growth rate, or you're using the capitalization of cash flow method, and you're going to have a single long-term growth rate. Marc, I'll ask you first. Where do you get your long-term growth rates? And tell me, if you could, bracket it a little bit. Again, in general, there are exceptions. Each company, industry can be different. But in general.
I think a starting point is always where your inflationary growth rate is for us. And, whether you're doing a DCF or a capitalization of earnings type method, when we start to block it off of where we're going to be, part of it looks at is how risky is my cash flow at the end of the day. Because if I'm going to build in a lot of real growth, but my cash flow already is a starting point where I might have tapped out on my resources, I can't go much higher than inflation, because over a long-term horizon, I'm going to overvalue this company. If I think I'm in a point where there's a lot of potential additional growth, then I can go maybe 1 or 2 basis points above inflation over a long term.
Okay. Lari?
Yeah, I think Marc brought up a good point. Is it kind of depends on what you're doing in your cash flow, and it depends on the profile of the business. If the business has real growth, then I think on top of inflation, you do have to have some concession for GDP, some real growth, because otherwise, if you're just using inflation, you're basically saying this company's stagnant and they're going to slowly die, because the inflation's going to lift everything up. But how does the GDP impact that, and does this company have a profile that fits with that? Is it in the mature stage? Is it at a declining stage? How does it fit in with inflation? If it's declining, surely just sticking with inflation or something even smaller than that is good. But I think if I really truly think that there's growth opportunity for the business itself going forward, there has to be some additional, concession for that in your adjustment.
Yeah.
7% is way too high, though.
I agree. Well, my rule of thumb when I'm reviewing work done by the people that work for me, or I'm reviewing the work from another expert, is 3 to 5%. If you're above 5, I want to know why. If you're below 3, I want to know why. I think the sweet spot is 3 to 5%, slightly more than inflation. Okay, inflation runs around 2.5, something like that, and real GDP can run 2.5 to 3. and so on. We look at the Livingston survey that comes out every 6 months. It has a 10-year consensus forecast. You could probably use it as well. But do either one of you disagree?
No, no.
I'm not saying you shouldn't go below 3 or above 5, but if you are, there better be a good reason.
Well, I think too, the interesting thing is if you're going to go below 2.5 for inflation, you might as well run a DCF till the company dies.
Yeah, well,
Yeah.
okay.
You know, because at that point, at some point, you're not going to be able to sustain any going concern premise anymore.
Particularly if you're raising prices at inflation.
Exactly.
Okay. Okay. I asked this yesterday, and this is going to be some of the very little overlap here, but I'm interested in this because people are writing articles about this. So, Lari, I'll start with you. Is the build-up model still valid and supportable? I asked this question to the panel yesterday. I'm not going to tell you what they said.
Well, I wasn't here, so I don't know the answer.
Okay.
So I'm going to have to guess at what their answer might have been because they're probably smarter than I am on cost of capital stuff. I actually think the build-up model has legs and it has a good place for small, closely held businesses. I mean, my personal philosophy is that if you have a small, closely held business, build-up is probably the best way if you're going to use an income approach to analyze that risk. And modified CAPM is I kind of in my own shop reserve that for medium to larger size businesses that are well run, have depth of management, have more than one shareholder running everything. And a lot of people, and you even said it, if you do everything right, you should come up with the exact same percentage. But the theory behind CAPM is different than the theory behind build up. Mm-hmm. And the theory behind CAPM is that you can diversify away risk. And modified CAPM, we modify that for purposes because we know we can't do that in private companies. But I just feel like the build up method is kind of a simpler, straighter way of getting there. So I think it has legs. I think it's good. I know there's a lot of criticism on it right now, but
yeah. Yesterday after the session, somebody came up to me and said, "What articles are you talking about, and who are you talking about with the build-up model?" And I said, "Well, there's one at the top, and it's Dr. Aswith Damodaran is very anti build-up model. He's also anti-modified CAPM.
But he doesn't have to make a living doing valuation work. So I just want to put that out there."
I don't know how many small private company he gets involved with or values. Maybe he does. I don't know. And but he thinks all these adjustments should be made in the cash flows themselves. But what do you think, Marc? Build up okay?
The short answer is yes, and I'm going to tell you why. I think what's amazing is the evolution of the buildup. It's basically a spider now. There's 8 arms out there, and when you do a lot of litigation work like we do, and you're in front of a trier of fact, we have to defend the rates that we come up with. And when you use the 8 arms that's in a buildup methodology, you can show the empirical data and the consistency philosophy to get to a discount rate that is supported by numbers somewhere. And that support or empirical data that gives you credibility to get to a discount rate. So I'm a firm believer that the buildup method is still viable, and it gets you through to the trier of fact who's out there that you need to defend your discount rate with.
Yeah, I mean, to think about this. You're valuing a company worth $5 million. Are you going to use a capital asset pricing model, just a capital asset pricing model, which will then require you to have you're not going to be able to use a capitalized cash flow model now. You're going to have to do probabilistic forecasting. And so your $5 million worth company, you're going to have at least 3 sets of projections to use the capital asset pricing model. And the capital asset pricing model is going to, on its own, all things being equal, give you a ridiculously high value. So one of your scenarios will probably have to be go out of business to get to a value that makes some sense. All right, other criticisms. There's lots of articles coming out about this. Mike Crane has written articles on it. He did his doctorate on that, his dissertation. Is the size premium dead, or is it still valid, Marc?
I mean, I still think it's valid because I put it in all my buildup methodologies. When
So you're saying it's valid. There's a legal term for that a judge will say. I forget the legal term for it. Just because you say it's so, it must be so.
Right.
There's a Latin term for that. I had Latin in high school, but I forget a lot of it. Go ahead.
Ipsy did.
Ipsy, okay, that's it. Ipsy Dixit, right? Okay.
Right. So it's when you look at getting rates of return, again, if you're going to say the size premium doesn't exist, you have to capture it somewhere. there's definitely risk involved in these companies. So until I'm convinced that the buildup methodology is dead and the empirical data that we have to justify smaller companies or risk, I'm still going to incorporate the
And
size
if you do
premium.
everything the same and take out the size premium, you will get a vastly larger value. Laurie?
It absolutely has a place, and I will continue to use it. You can just look at multiples over time in different size brackets, even in the public markets, and just, the empirical data shows this, that, there is a difference. Size does matter always. And the bigger, the stronger the company, the more stable, the less risk. I mean, we can all illustrate that, through analogies with the trier of fact. So I have no problem using it, and I have no problem defending it.
Okay. I mean, I wish 20 years ago, they didn't use the term size premium. I wish 20 years ago, they would have used CAPM correction methodology or data, because that's essentially what it is. It's in excess of CAPM. I don't have time to go into the details of that, but that's how it's calculated. They say they take all these deciles or categories, and they say, here's the actual return, and then here's a predicted return based on just straight up CAPM, and then that's the size premium. So I wish they would have just said CAPM correction. I noticed that Duff and Phelps has been calling it CAPM correction in some recent articles that they have published. Mostly Roger Grabowski has written some articles that has that term. Ashok?
See, one thing we have to be careful about.
Close to the microphone.
One thing that one has to be careful about when terming something a size premium is to acknowledge that there's a lot of liquidity issues involved with size premium. So if you stick the size premium in, then you cannot simply stick another large DLOM on top of that.
Well, Ashok makes a good point. I mean,
Right.
A lot of the size premium, I do believe, has liquidity issues in it. However, if you're using restricted stock studies, the public companies that are in the restricted stock studies suffer from the same problem of lack of liquidity. So some people are saying, well, you can't use the restricted stock studies and apply a discount for lack of marketability because some lack of liquidity is already embedded in the size premium. That's not totally true, because those public companies, a lot of those, the starting point is not that high a liquidity for that company's stock. And Ashok has done a lot of research on differences in lack of liquidity based on publicly traded companies, not the private, publicly traded companies.
See, one thing that a lot of practitioners are not recognizing is that the restricted stock studies are really the bottom from which the discount should start. You're talking about publicly traded companies where financial statements are being filed with SEC, where a lot of information is available to both sides. For a private company, which may not even have well-audited statements, there's a lot of cost of information to be generated and communicated. Okay. So in my opinion, at least, the restricted stock studies give you the lower end of the discount, which then needs to be aggregated up for that lack of information.
Okay, thank you. We're going to end with say another question I asked yesterday. Future, okay.
Sorry to take your last 2 minutes, but I have a question. How many people in the room use two different models to determine the risk rate to see if they're both coming out the same?
Two different models?
Yeah, so like I'll do the build-up.
What risk rate are we talking about?
The
Cap rate.
The discount rate. So I'll use the old SBBI method,
okay.
And then I'll also use Rogers' method and see if they're coming out similar, rather than just doing one like I used to do.
Well, it's interesting. I had a conversation at one of the breaks with Jim Harrington with Duff and Phelps. And I said, our shop for years now has been using the CRISP data, old Ibbotson, and has also used the Duff and Phelps risk premium study data. Again, I call it, 1926 for the CRISP data, 1963 for the Duff and Phelps risk premium study. Duff and Phelps owns all of that right now. They don't own CRISP, but they do both those. I do them both, and I've been doing it for years. And you know what? The difference isn't that much. It's about 200-300 basis points, never above 400 basis points, usually 200 to 300. So I do them both. But one of the things I was telling Harrington is a lot of people are only using the CRISP data. That's okay, but there is another database out there, another same vendor, but another set of data that you can use. Future of BV. Marc, you're first. Where do you think we're at? We're growing fast. They used to, AICPA used to do all these surveys, fastest growing, segment and this and that. What do you think?
I think from the traditional BV and the way technology is moving, we're probably going to hit a giant wall unless we find creative ways to use our skill set and technology to interact with businesses in a whole different way. So I see the whole future of BV. If it's going to continue to be a growth industry, we have to re-engineer the way we do business.
Okay, Lari?
Yeah, I think that there's an issue, a difficulty right now in the tendency of analysts to want to just, instead of having the art and the science behind it, to rely more on science because that's going to be more credible and have a better backbone. And maybe AI and these other elements, are going to help us to do that in some way. But I think you're never going to be able to take that subjectivity piece of it. You have to have, the professional judgment involved. So sure, I think we're going to have some bumps in the road coming up. I don't think it's going to dry up and blow away. But I think that the wave that we've been riding since the mid 90s with the IRS compliance work is probably going to go by the wayside. We'll take our tools, our toolbox, retool ourselves, and continue on doing something related in the same field.
Yeah. How many people in the room think that BV has become more competitive in the last few years? And I do. So, okay. And particularly with different, I think it's a general question. It has a lot to do with what service lines you're doing, I think, to a degree as well. Thank you very much. I appreciate it. And if you're going home today, have a good flight or good drive or good train ride. Thank you.
Everyone, please stick around. We're going to announce the winners of the raffle. So if you want to know if you're a winner, and if you are a winner, we ask that you come up and collect your certificate, and we're going to take a picture with all the winners.